Welcome to Capital Insights. Thanks a lot for being with us. We're approaching the end of an era both in the financial markets in the United States as well as the real economy. As you may be aware, the Federal Reserve is going to cease its quantitative easing operation next month, October of this year. As we look back, quantitative easing by the Fed began in November of 2008, so it's going to be a full 72 months, if you will, that this project has been underway. This experiment by the Fed, as this is something that's really never been done before and has been unprecedented in U.S. history. Over that 72-month period, the Fed has been printing money for 60 out of those 72 months, or 70% of the entire time. And again, over that entire period, the Fed has printed just shy of $4 trillion. That's a lot. So it's going to be a little bit different for both the financial markets and the U.S. economy ahead without this very important source of liquidity, of stimulus being available. Just tangentially, over the same period, the United States government debt has doubled, another $8.5 trillion. Combine that with the Fed and what the Fed has done, and we're looking at about close to $12.5 trillion of stimulus by both the government and the Fed. That's 70% of GDP. That's a lot. So at least for now, the Fed portion of that stimulus is going to be coming to an end. As we look back, we'll remember that when the Fed started QE, they had two purposes in mind. One was to get unemployment down, increase employment, and the second was to really stimulate the real economy itself. They figured that they'd be able to stimulate the real economy vis-a-vis through what they called the wealth effect. So on the unemployment front, what's the report card? Unemployment's fallen from around the 10% range to about the 6% range. That's headline unemployment. But there's another employment number that the Bureau of Labor Stats reports, and it's called the U6 number. It includes not only those without work, but those who are working part-time because they can't find a full-time job. And that's down to as little as 1 hour a week, if you will, of part-time work. That number's about 12%. So what's the reality of the job market in the United States? What's the reality of unemployment? It's probably somewhere between those two numbers, plus or minus. But again, on a headline basis, victory vis-a-vis getting that headline unemployment number down. The second goal of QE was again to stimulate the economy. And what the Fed figured, they believed in, what's conceptually called the wealth effect. The Fed figured that if they could get the value of household assets higher, and the two primary household assets on the household balance sheet are real estate, number one, and stocks, number two. If they could get those values higher, people would feel wealthier and they'd go out and spend money. In fact, in the Fed's dream world, they'd borrow and spend money, very much like we'd seen in prior economic cycles. So how has that all worked out? Well, let's look at a very, very important chart. What we're looking at right now is the year-over-year rate of change in household net worth in the United States, right alongside the year-over-year rate of change in personal consumption. And as you can see, over a broad number of years, these two numbers were very highly correlated. In essence, they moved in the same trajectory over time. In the late 1990s, household net worth growth shot a little bit above personal consumption, really due to the fact that the dot-com era in stocks was occurring, before that collapsed. In the mid part of the last decade, it was real estate. Real estate prices were going up very significantly, and the rate of change in personal consumption followed along a little bit too. But in this cycle, we're seeing something very, very different. Yes, the year-over-year rate of change in household net worth has gone up very significantly. But incredibly enough, the year-over-year rate of change, year-over-year, in personal consumption is pushing a half-century low right now. So even though household asset prices have gone up, stock values have gone up, and housing prices have gone up, consumption hasn't followed. The year-over-year rate of change right now in personal consumption has only occurred during recessions of the last 5 decades. That's the fact. So in one sense, we believe the Fed is ceasing QE, not because they've been wildly victorious on the economic front, but because this whole concept of the wealth effect has not played out. And the Fed knows at this point that they're very much distorting the financial markets. Through QE over the last 5 years, this printing of money to buy bonds in the open market, The Fed now owns close to 35% of total 10-year U.S. Treasuries. And likewise, they are the single largest owner of mortgage-backed securities in the United States. They've kind of cornered these two markets. So in one sense, they know they can't continue. This is what it's all about. This is why QE is ending. So as we look forward into this, if you will, new era beyond October of this year of the Fed no longer printing money, what lies ahead for the real economy? And secondly, what lies ahead for the financial markets? What do we need to watch? Number one, for the real economy, let's look at another set of data. Very, very important. What we're looking at here is the very long-term year-over-year rate of change in the top clip of the chart of average hourly earnings in the United States. And the bottom clip is, again, that look at the year-over-year rate of change in personal consumption expenditures. As you can see, over really a half-century period now, those two indicators, those two year-over-year rates of change have been very highly correlated over time. Directionally, they run in tandem. And what it tells us is that the primary driver of consumption in the United States, and remember, consumption is 70% of GDP. The primary driver of consumption is wages. It's not higher stock prices. It's not higher real estate prices. It's higher wage growth and a healthier job market over time. So in terms of the real economy, what we really need to key in on and watch for as we move forward is not only the health of the labor markets, but growth or lack thereof in real wages. Very, very important. We'll be watching that as we move ahead. What about the financial markets? As if we take a little trip down memory lane, at the end of QE1, in fact, from the beginning, before QE1 even ended, the financial markets, the stock market, went into a corrective mode, corrected 10% top to bottom as QE1 was ending. As QE2 was ending, the stock market corrected 20%. That's a big number. It's almost approaching a bear market. What about now? Well, investors in the financial markets have known for a number of months now that QE is going to end. This is no big surprise. It's been telegraphed by the Fed for a number of months. And at least so far, the financial markets haven't even blinked. In fact, as of the recent close, the financial markets, the stock market, is at an all-time high. Why is it different this time? Why aren't we having a little corrective mode, knowing that the Fed is no longer going to be providing this magnitude of liquidity to the real economy? Well, at the current time, what's making up for that is the fact that the Bank of Japan is printing twice as much money as the Fed is. Just this week, the People's Bank of China announced a very short-term one-time stimulus package of 500 billion renminbi. In US dollars, that's $100 billion. And they're going to inject that in one fell swoop. And then lastly, Europe. Europe and the European Central Bank has been promising additional liquidity vehicles to come. And we'll find out more about this at the October 2nd meeting of the European Central Bank. So, a little bit of an end of an era here as QE comes to an end. Will QE ever start up again? The chances are it probably will not in the United States unless we have a very meaningful contraction in the economy or a very, very meaningful decline in the stock market itself. As we look forward, not only are we watching what's happening in foreign countries, and we've talked about this many times, not only in our monthly writings, but in these video series too, that we have to watch what's happening with global central banks. In the United States, the Fed has told us they'll keep interest rates, the second part of QE here, at very low levels for a considerable period of time, the exact wording that they're using in their FOMC communiques. So we need to watch short-term interest rates in the United States. How will they react? Will they move out ahead of the Fed as we move forward? The printing money part of QE is coming to an end. But there's a second part of what the Fed has done in terms of monetary stimulus, and that is we need to get short-term interest rates back from an artificially lowered rate near zero to somewhat more of a free market environment. Will that happen without any kind of disruptions in the financial markets? The answer at the moment is we really don't know. But the most important thing is, as we've talked about many times, we watch the weight and movement of global capital. We watch currency cross rates globally. It's determining a lot of what's happening in that weight and movement of global capital. And we watch not only the fingerprints of the real economy in things like average hourly earnings, but we also watch the financial markets for what they're anticipating ahead. As short-term interest rates move higher, and we've seen a 2-year Treasury yield go from 0.2 to 0.6 over the last 12 months. That may not feel like a lot, but that's a tripling in yield. We watch those rates to see what the markets are anticipating ahead. The end of an era, we'll probably never see this again. The U.S. economy and the financial markets, very incrementally, will need to stand on their own 2 feet as we move forward. We'll be watching and monitoring as we move forward. We very much appreciate your time and being with us. On behalf of the entire team at Capital Planning Advisors, thank you so much, and we'll see you very soon. I'm Brian Pretti.